but it's hard to know what Trump is going to do tomorrow. So
one thing is what has happened in the past,
और ये गिरावट बढ़ती जा रही है अब सेंसेक्स
and one thing is what we think is going to happen in the future.
People classify regimes in a very simplistic manner like bull markets and bear markets.
when we're looking at the market, we're looking at cause and effect. So what causes price to move ideally is, the question. It's important what Trump says, whether, like he's going to put a 20% tariff or a 30% tariff, but is it knowable? No one knows, right?
How is that helping you in taking decisions?
The way we look at it is, what is my best chance of success for the next 3 to 5 years?
When I'm making the bet, is it favorable or not? Because after that, what happens is not in my control. We want to be right 6 out of 10 times, 7 out of 10 times. We don't want to be right 10 out of 10 times.
Is it actually possible to identify these market regimes in real time, or welcome back to Leverage by Qode, where quant thinkers take the mic and we decode the markets through a sharper lens. In our last episode, we explored how asset allocation shapes risk, volatility, and long-term outcomes. This episode is about market regimes. It's about understanding the environments markets move through bull, bear, sideways, and why each regime carries a distinct statistical and behavioral characteristic. Thank you, Gaurav and Rishabh. Really excited to have this discussion again.
Thanks, Pratik. Thanks for having us here.
Yeah, so today's topic is understanding market regimes. So first question to you is, people classify regimes in a very simplistic manner like bull markets and bear markets. My question is, how do you look at market regimes? How do you differentiate them? Are there regimes in the first place when we look at, any kind of market?
The way we look at it is that, there are different regimes and these exist. So if you had to break up the Indian markets from 14 to say 17, we saw the crazy small cap rally. And then because of elevated valuations, we saw from 18 to 20 only, quality and value ended up doing well. Small caps got battered. And then post that, because of the quantitative easing program by the Fed, we saw from 2020 March onwards up until 2024, we saw a crazy bull market across different asset classes. So there are different regimes. Now within this also we have seen times of heightened volatility, times of low volatility. For example, like in 2022, we saw that volatility had gone up because of a war kind of an environment. As we speak in 25 and 26, we are seeing bursts of volatility every time some announcements are being made. We think that this can continue going ahead, but these are the different regimes that do exist.
Yeah. So one thing, you can, the way we try and look at it is, one thing is, what has happened in the past, and one thing is, what we think is going to happen in the future. So a lot of people end up taking a call on what has happened in the past, and then, assume that like this is going to continue and end up making portfolios in that manner. The way we look at it is, what is my best chance of success for the next 3 to 5 years. So we don't, necessarily predict, whether it's going to be a bull regime or, a bear regime or a sideways market. That's not how we like to predict it. We have, let's say, an internal indicator which tells us, from 0 to 100, how is the overall market valued. It could be divided by segments. It could also be divided by different factors. And then we end up taking a call on whether, this makes sense, for us to be invested in. For example, in September of 2024, we were getting a signal that on a scale of 0 to 100, 80 was, the score for, the market. So we ended up taking a, call that we need to be invested in safer portfolios at that point in time. So, it's possible that the bull market could continue. It's possible that, there could be a bear market that can come, after that. But we try and look at what is in store for me for the next 3 to 5 years, and then try and do that. There are also some, things that end up getting correlated. For example, if there's an extended bull market, our signals automatically end up telling us that the markets are overheated and makes sense to be invested in safer portfolios, and the other way around as well.
So if we look at just the price, right, and we look at different regimes, and based on price we can make a differentiation, but market regimes are much more and beyond just looking at the price, right? There are other factors. What could you talk about more about those factors that actually influence how the market is behaving in a certain period? Could you expand on that?
Yeah, so I'll tell you, like, price is sort of the output, and it is not the input, right? When we're looking at the market, we're looking at cause and effect. So what causes price to move ideally is, the question that we want to ask ourselves. And I think one of the things that causes price to move in the short term is sort of macroeconomics. So where interest rates, right, where what kind of policies the RBI is putting into place, what kind of policies the Fed is putting into place, as we see, because of the trade war that's going on between the US and the rest of the world, that also influences the market. So if you look at any sort of short term price movement, definitely macroeconomics has a play. If you're looking at longer term price movement, it is underlying earnings. Now the underlying earnings is also impacted by these policies, but so they all are interrelated, right? So the market is a very complicated place, and you have all this information available. You have to choose what information do you want to give weightage to and what you don't want to give. So Warren Buffett has this thing where he says that piece of information is desirable to him. One thing is when it is important. Second is it knowable, right? So a lot of information is important, right? So when you're looking at, say, macroeconomic stuff, it's very important, but it's hard to know what, say, Trump is going to do tomorrow. So it's important what Trump says. If he says that, whether interest rates are, whether, like he's going to put a 20% tariff or a 30% tariff, but is it knowable? No one knows, right? Probably even he does not know what he's going to do the next week. So the reason we're speaking of this is because all these factors end up sort of creating regimes, and they create small cycles, and then they end up becoming a large cycle also. So, I think that's where.
Yeah, absolutely. So, in fact, apart from price and other things that Risha was mentioning, I think valuation is another thing that we try and look at very closely. It's possible, let's say the price has gone up 10%, but what if the earnings have gone up 20%? Your bet has become even more favorable at that point in time. So it's not just where the price moves, it's how it's moving in terms of valuation. So an example that I can give is, again, if we go back to 2024 and early 2025, we had seen that the price had gone up for, let's say, mid caps particularly and small caps particularly, but the earnings hadn't caught up with that. So either of two things could happen. Either the earnings can grow, and then if it grows, let's say another 10%, it's possible that the multiples remain flat. Or if the, earnings don't grow and, the multiples decrease even further. So that's where, we try and identify how the asset prices could move.
Right. So, for example, if we take a cyclical sector, let's say a commodity sector, where there are cycles is a part of this, so we can probably understand market regimes in that way. What you are saying is that I can still have earnings, but the way the market is going to value those earnings in different periods are going to be different. Hence, my returns could look different, and me understanding this regime is extremely important, right? So, could you help me understand based on, let's say, historical periods of how we can look at these regimes from a valuation point of view?
So the idea over here is that, you said that looking at cyclical, businesses or sectors, right? When we are talking of a regime of a cyclical business, what we are identifying as an investor is that, okay, fine, when is this cycle going to take off, right? When is it a good cycle? When is it a bad cycle? For example, as we speak, we are seeing, a takeoff on the metals side, right? So we are seeing that, okay, fine, metals are say copper, gold, across the board, everything is doing well. And then how that trickles down into a business. So you start from the top, you start from, okay, fine, which metal is being affected, what policy is it being affected by?
The supply demand dynamic.
And so there's one is supply demand, the second is macroeconomics, right? So policies of each government. So, if there are some curbs on some metal being imported from China or exported from China, how that affects supply and demand. So getting into details of that, then you'll figure out, okay, fine, this is how it's going to affect the raw material of a particular business. And then you'll understand, okay, fine, if the raw material of this business, of this, particular, say, copper, right? If copper price is going to go up, can it be passed down to a consumer? Will it help expansion of margins of a particular business? Then you can play that cycle. We spoke about this earlier also. It happened in solar, right? Wherein the government is doing a lot of capex. So when the government started the capex, say back in 2018-19, in the budget and multiple policies, they made announcements, right? That, okay, fine, we are going to provide subsidies. We are going to give advantages to guys who manufacture, solar, all sort of solar equipment.
The inflection point for the cycle.
Exactly. So that is the inflection point of the cycle. If you want to make this play, even after knowing all this, it's going to be a very difficult, job. Very few investors are able to do it. It requires a particular level of skill. It requires, years of understanding. And, I think playing this is not that easy.
These market regimes, understanding market regimes, how is that helping you in taking decisions and the way you manage money or the strategies that we have? How does that go into the way we manage?
I can take this one. So I'll tell you, we don't actually try to predict the regime, every single time. What we are trying to sort of do is that, okay, fine, when I'm making the bet, is it at an attractive valuation? So what we try to understand is that, okay, we want to be right 6 out of 10 times, 7 out of 10 times. We don't want to be right 10 out of 10 times. The idea out here is that when I'm making the bet, is it favorable or not? Because after that, what happens is not in my control. But what I can do is that limit the downside. So, looking at the all-weather portfolio, for example, the idea is that you put multiple asset classes together, and each of these will perform in different regimes, right? For example, last 1 year we've seen that commodities have done extremely well, so that's rewarded our portfolio. Equities have been flat or up, single digit, 8-9% or so. So idea is that because you don't want to predict, and you cannot successfully predict over long periods of time, over 1 quarter you could, over 2 quarters, even over a 2-3 year period you could, but doing this repeatedly becomes hard. So what we've done is that we've combined multiple asset classes which are not correlated to each other, and sort of smoothens out the equity curve. So the idea out there is that you don't want to predict a regime, you want to remain invested. So at the end of 10 years, all the assets will end up doing well, but they will do well in different time periods.
Right. So the indicator you mentioned, right? What we are trying to do is not look at the past, but in fact try to look at the future, and whatever looks attractive from a valuation point of view, we would take decisions. But could you, for example, go in more detail, explaining me some examples if you can give, like let's say this is a very high volatile regime, which factor would do well? Or let's say in a lower valuation kind of a market where everything is trading at low multiples, what kind of a factor would do well? If you can just help me that this particular regime, this particular strategy ends up doing well.
No, in fact, we end up looking at a lot of factor strategies, very closely to see what can be best suited for different kinds of environment. For example, in a bull market, without a doubt, we can say that a momentum strategy can do well. Within momentum, what ends up happening is, the stocks that have run up the most in the last 6 months, we end up, buying them and keep rebalancing them every, 6 months. So without a doubt, in a bull market, we can tell you that, this does well. The question is, what does, the best within a sideways market and, down market. There are also, I don't think there's a very clear answer. In a down market, I can tell you that value does well, low volatility, does, better. But, there could still be a time where, over a 3-month, 6-month period, some other factor could end up, outperforming that.
I think here, I can add that liquidity is a very big driver, and where liquidity flows, you'll sort of understand, what's happening. So last 1.5 years, we've seen that liquidity sort of, dried up out of the equity markets. A lot of froth in the small cap space, so that did not do extremely well. But Nifty was yet up 12% in the last 1 year or so, right? So understanding where liquidity is flowing to, and then you will sort of realize that, okay, fine, if it's flowing from the Fed, how does it trickle down into equity markets, and then what gets rewarded first? It's a difficult exercise, but this is an exercise that people like Howard Marks and more sophisticated investors end up doing with institutional grade tools.
Okay, so what is the cost of misidentifying a market regime? Let's say you get stuck at the top at the wrong regime, the wrong strategy. Could you just explain what the downside of that is?
Sure. I can take this one, and I think I'll tell you, we've had this stint with I'll be honest, with the solar sector, wherein the bull market in India sort of started in 2020, 2021, where it was at very nascent stages, right? And then moving to something like a 2024, 2025, we started seeing that valuation started getting sort of elevated. And what happened in 2024 and 2025 across all businesses, right? There are about 10, 15 odd solar businesses that are listed. People were thinking that this is going to continue for 10 years, 15 years or more. And the way we started valuing these businesses was sort of wrong. Right, across the board, markets were valuing these businesses on a price to earnings multiple, and we think that a price to earnings multiple only comes into picture when the business can last for 20, 30 years or more, right? If there is no clarity, so specifically we consider a solar business like a commodity play, right? Then you want to look at it from a different lens. You don't want to look at it from a price to earnings lens. You want to look at it from a price to book lens, because you understand that after a couple of years, there's going to be overcapacity, margins are going to contract, and the business will become a low ROE business. So in commodity plays, what we've realized is that your entry and exit matters a lot. So timing makes a lot of difference. And more important than exit, I think entering really early in the extremely nascent stages to get there, even to enter early, I think the thought process has to be that you want to start with, understanding everything about the sector, understanding capex cycles of the government. So it's a lot of work. So I think at least, from our understanding, this is where we were at in terms of regimes and commodity place. If Gaurav wants to
Absolutely. So, Pratik, you mentioned about what's the cost of, getting wrong. That again brings us back to the concept of asset allocation. When we are looking at, seeing what could be best suited for the next 3 to 5 years, it's not like we're changing 100% of the portfolio from, let's say, a momentum, factor to a value factor or a low volatility factor. That's not what we're looking to do. What we try and do and look at allocations that would work out to be the best. For example, Rishabh mentioned about Qode all-weather strategy and how we are maintaining fixed allocations within them over a period of time. It's possible that the allocation over a next 3 to 5 year period could change, but those things are very slow moving. It's not like the things change every 2 months, 3 months. For them to change, it ends up taking 6 months, 12 months. So we keep running these models and end up seeing what sort of allocation is now working for me best. And then I end up, taking that call on the portfolio saying that let's move this allocation from a 40% to a maybe 30% or a 50%, or let me introduce another factor with a 20-30% allocation and then, see how does that benefit me over the future. So because of that, the volatility in the portfolio decreases, the certainty of a particular return increases, and your risk adjusted return increases because of that.
And no matter what regime it is, you would not end up with a really bad return.
Correct.
So is it actually possible to identify these market regimes in real time, or are we all smart only in hindsight?
No, I think it's possible to identify it. It just requires a lot of work. All of these things require, extreme amounts of work. We've seen investors do extremely well in these kind of cycles where you've picked up even 100 baggers. It's rare. I will not say this is a common trait and every person can do it. It's possible if you want to figure it out, but you have to put in all that hard work, blood, sweat and tears, and maybe your success rate will be low. But I think there is a chance out there.
Yeah, just one thing to, what Rishabh is saying, I can tell you that sometimes it's absolutely unpredictable. Like, for example, now if you look at value as a factor, it works very well in, other developed markets, let's say the US and, other markets. Now, if you had just looked at the period from, let's say, 2000 or 2005 till 2020, you would have seen that value didn't do well at all. It's possible that if I was in 2020, I would just write off saying that value does not work in India, if I'd not done a one step further level of research on why is it not working and why has it not been of interest to, let's say, investors. What ended up happening over the last 5 years is people ended up realizing that a large portion of the value index ends up being PSUs. So for example, PSU banks, there are also oil and gas companies part of that, which ended up trading at lower valuations for a reason. Now from the government side, there's been a lot of push on the PSU companies, where the idea is to push that, and if the asset quality is bad, let's improve that. If the efficiency is bad, let's improve that. As a result, the value index has done really well. In fact, last 5 years, it's given north of 30% return, year on year. So I would say this is, something that I could not, predict just based on numbers. I have to be informed about the qualitative aspect of it, understand that, there could be a push from, let's say, the government about a particular thing, and this could mean that value could increase for like these businesses, and then the returns for me could be better.
But I'll tell you, Pratik, the idea from an investor lens is that, see, you don't need to do everything and you don't need to know everything. I know, guys, there is an investor in the US who's made like north of 25% per annum for a long period of time, just understanding one sector, say like looking at the insurance business and just playing that out year after year over a 20-30 year period. So you don't need to sort of understand that, every regime I'll figure out, okay, these 5 years it's solar, next 5 years it's going to be something else, and then the next 5, and I'm going to successfully do that. Very hard to do that. Even if you can understand, you figure that circle of competence, just work within that, you can do extremely well as an investor.
You just need to get one real cycle right. And then
Exactly.
Absolutely.
Thank you, guys. All right, so time for scroll check. So let's see what the internet thinks. First one is Nifty 50 up 13% in 12 months, all-time high about 26,300 in January. SIP flows at 26,000 crore plus, DI is buying at record highs. GDP at 7%, repo rate cuts at 125 basis points. Every macro signal says bull market. I'm going 90% equity, 10% cash, riding the wave. If this isn't bull market, nothing is.
What we are looking at currently is only like, what this post talks about is just the headline numbers. For example, if you look at Nifty, yes, it did, kept touching all time highs. But if you take one step below, look at mid cap, small cap, micro caps, what has happened is last 1 year, Nifty has gone up by 10%, but let's say, small cap has gone down by 5%, micro cap has gone down by 10%. So it's important, like, from an overall perspective, you can see that, this particular segment makes sense, but maybe there's a segment that makes more sense if you, take a, step deeper. The idea is also to see if earnings are keeping up, with the growth that's expected. And that's what is going to cause, the returns to grow in the future.
Okay. Next one is to what you were saying, Gaurav. Median small cap is 33 to 44% below all-time high. Small cap 250 PE has compressed from 35 plus to now around 26, 27. FIs have sold out. This is about the blood in the streets moment Buffett talks about. Deploying 75 lakh lump sum into small cap index fund today. In 3 years, this will look like a buy of a lifetime. Would you say that that's the right approach?
So I would say, I think the thinking here is, definitely correct. What, sometimes headline piece don't tell you, you end up finding out one step deeper. Let's say if you talk about the Nifty is trading at roughly 20 to 23 times earnings. But if you look at the constituents of Nifty, the 50 companies that are there, and you end up looking at the median P for all of these companies, you'll see that the median is higher than 30. So looking at just the headline number, I don't think, makes sense. You have to look at the constituents, because you're not making a, portfolio which is similar to Nifty, which is, 40% of, concentration in 5 stocks. You end up, diversifying the portfolio over the 50 stocks. So same with, let's say, the small cap index. You can't just look at the headline number. You have to look at, one step deeper, look at the companies that you're investing in. And then, a quant method can help you, if you're taking a bet on 40, 50 companies. But for a specific company, you'll have to still do your research and see if this, broadly makes sense.
But I think the thought process is right, that basically what you're trying to find is that is there like a deep discount available in the small and mid cap space. There is a good chance that you will find a large number of businesses out there that could actually have deep value.
Right.
So there is a good thought process out there.
Okay. Next one is the talk of the town. Nifty IT down 22% in 12 months. TCS, Infosys, HCL all cracking. 4.5 to 4.8 lakh crore wiped out from the IT market cap in weeks. FIS pulled 11,000 crore from IT stocks in the first half. US tariffs hitting outsourcing. US tech under pressure from AI fears. This is not a correction, this is a regime change. The IT bull market is over and moving to 100% debt until clarity emerges.
I think I can take this one. So I've got this question multiple times from investors on two sides. One is that, do you think AI is going to be the next thing? And the second is that, what do you think of the IT sector in India? The way I look at it is that if I'm not able to predict earnings after 2-3 years, I don't think I should even be, taking a position out there. See, with AI, for example, is it going to be disruptive? Very hard for anyone to say. There is a chance, there is not a chance. We don't know. So no one knows what's going to happen after 3 years, and will it take away, jobs? Will it not take away jobs? And when you don't have an answer to something like that, you refrain from taking a position in either places, right? So even on the IT side, do you think it will be a disruptor? Honestly, I don't know. It depends on how AI will sort of play out after 3 years. So I'd rather sit on the sidelines than take a position in any of these places.
Right. So I think I completely agree with Rishabh. Just to add to that, what ends up happening is the type of buying for someone to end up buying these companies would be value sort of buying. Like if you end up just buying like value businesses, I think they're available for a great value. What we generally try and look at is growth businesses. So for us, if you ask us, not a lot of IT companies come into that segment where we are expecting within the next 3 to 5 years for them to double or triple. We don't see those businesses end up doing that. There is an angle that AI will play into that, but I think there are also other things that are happening in the market because of which we don't see those things end up happening. Having said that, AI, I think, is specifically, for certain sectors, it's going to, affect them a lot. We're still monitoring like which ones could it affect them most. For example, a couple of days back, there was a news on, Claude coming out with, a segment on cyber security, and all the cyber security companies fell 10, 15, 20%, all lower circuit. So I think there is some panic that does get created, which creates these buying opportunities. I don't think it's going to replace 100% of what these companies to do. So I'm still tilted towards, buying, the growth businesses at discounted valuations, but we still keep evaluating this, how this thing keeps playing.
Just a plain understanding of because something has fallen, now it's an attractive buy, or that because it's fallen, we just have to write it off that it's done. Is not the right way of looking at it. Got it. Perfect. So, speaking of these questions, we have the next segment, which is answering the internet, where we've received questions in our DMs, and I'll be reading out to you. So, the first one is, I've been hearing a lot about factor investing, momentum, value, quality, but which factor should I pick for the current market regime?
I think, I can answer that question today as to which factor you want to pick. But if you would ask me, what is the process? I think, very hard to, we already addressed this before, very hard to constantly predict which factor is going to do well in every regime. So that's why on our end, what we end up doing is that we have exposure to almost a couple of or 3-4 different factors, so that we don't need to time the market. At some point, something will do well. And, over a 5-10 year period, everything will be in the green.
Correct. And we also touched upon asset allocation before. What we try and do is, as Rishabh mentioned, we are exposed to different factors, using different methods, but we're also exposed to multi-factor models, which include momentum, quality, and, other things, combined. So that also helps us, overcome these challenges of trying to predict which factor is going to do well.
Next one is market seems stuck. Nifty has been range bound from 2500 to 26,300 for months. I'm frustrated. Should I just stop my SIPs and wait for a clear trend?
See, that's a definite no. I don't think there's any elaboration on that. You continue SIPs. This is called a time correction, and it happens, very often. Every few years, you see this kind of time correction. Stopping your SIPs absolutely makes no sense from here.
Absolutely. In fact, there was a study that came out recently that there was one fund of DSPs. I think it was last 15-20 years it's been live. There have been lakhs of investors who've been holding that fund. The number, if I remember correctly, only 25 investors have been there from the start till the end. The fund did what it was supposed to do. It gave the returns, over that period of time. If you were invested in that period, you would have made those kind of returns. But the immediate, tendency of people is, if the markets are falling, let me, sit out on cash. Or maybe if the markets have topped, let me sit out on cash. SIP is designed to, ensure that you end up getting more units when the markets are low, you end up getting less units when the markets are high, and it ends up serving a purpose over the next 20 years. So I don't think moving out of an SIP is ever an option. You can think of doing SIPs in different products if you think that this is going to be better over the next 3 to 5 years. And that should continue, but I don't think the SIP should stop.
Perfect. Thank you so much, guys. It was lovely talking to you.
It was indeed an insightful session, Pratik.
Thanks, Pratik. It was great.
Thank you, guys. If this conversation helped you understanding different market regimes and cycles, like and subscribe. And for more market-related insights delivered straight to your inbox, hop on to our newsletter. Until then, happy investing from Team Qode.